What's special about the bank run that we witnessed last week on Silicon Valley Bank is how quickly it took place. It was the first bank run we've witnessed in the digital age. Two components of that. One is the ease with which depositors can withdraw money through electronic wires. Clearly, that existed in 2007, 2008. But the speed with which it happened through mobile apps and so on this time around was almost unprecedented, coupled with the fact that depositors themselves were able to organize themselves through various WhatsApp groups, through social media, into a frenzy, exacerbating the bank run. Just to put some numbers on that, we saw $42 billion withdrawn from this bank, Silicon Valley Bank, last Thursday. That's a quarter of the total deposit base. If you go back to 2008, Washington Mutual was a much slower burn. 17 billion was withdrawn over 2 weeks. This was the reason why regulators had to go in. The FDIC had to go in and take this bank into receivership on Friday morning. Normally they have a playbook engineered around going in over the weekend where wires are not permissible, and closing it down and transferring ownership. Another feature which makes it special is that ownership was not transferred. Various reasons, possibly relating to the flightiness of its deposit base. Other institutions, seemingly as of now, haven't expressed an interest in buying it. And so consequently, the FDIC is winding it down. And because of that, that led to the fear over the weekend that depositors wouldn't be made whole. And that takes us to what I think are two distinct features about this bank. A lot of people are dwelling on maybe the single root cause why it failed. But in my view, it was a confluence of two factors. It was the relationship between those two factors being, on the one hand, a disproportionate amount of uninsured deposits held by a small number of institutions. Silicon Valley Bank had about 90% of its deposits were uninsured, which is highly unusual for a US bank. And they were concentrated in the hands of just a few thousand institutions. On average, they had over $4 million on deposit per institution, which is more than the insurance threshold of $250,000. So factor one was just this very unusual deposit base. Not only was it uninsured, but the depositors themselves were very highly correlated. Banking works on the premise that deposits are rendered stable by being uncorrelated. This is a very correlated depositor base. And then the second factor was on the asset side of the balance sheet. A lot of those excess deposits were invested in securities, in agency guaranteed securities, and in treasuries, which were put on kind of yields of 1.5, 1.6% in 2020 and 21 when the deposits came in. Consequently, the bank was underwater on its securities. Actually, nothing new there. The peak mark-to-market loss was actually back in September of last year. That mark-to-market closed up as we got through December. And as of today, given what's happened in markets, we'll hear more about market impact and rates in a short while. But given what's happened, the mark-to-market loss would have shrunk even more. So that was already available for any of the customers to have looked at in the footnotes to the reports that Silicon Valley Bank filed back in September of last year. So that didn't get any worse. But clearly, banking is a confidence game. And when speculation erupted amongst this particularly correlated, unusually correlated customer base, trouble ensued, and we had the fastest bank run in history.
And Mark, just to sort of jump in now, you mentioned sort of the fastest sort of bank run, and then we've had another bank, Signature Bank, to go into receivership there. I mean, what was the rationale for that one?
So the common denominator is uninsured deposits.
Okay.
Both of them had about 90% of their deposits uninsured. That was the common denominator, rather than there being a common denominator on the asset side of the balance sheet. So Silicon Valley, like all banks, mark-to-market losses on its bond portfolio, but the common feature was really the structure of the deposit base. There's another issue as well, which is Silvergate Bank, Silvergate Capital. Technically, it hasn't failed. It's put itself into voluntary liquidation. Arguably, that was the trigger for the downfall of Silicon Valley Bank. Silvergate Bank, a lot of crypto depositors, they and Signature Bank both had what they called networks, which allowed on-ramping into crypto from US dollars. And a lot of their business was built around that. And arguably, this is something that the regulators independently, given what they've expressed around crypto, wanted to shut down.
And in terms of the policy response, so what we've had is a new facility by the Fed to accept on the asset side sort of collateral, and there's been assurances on the deposit side through FDIC and I guess the Treasury. What are your thoughts on those steps?
Yeah, so actually, arguably there were two steps. One is guaranteeing that all the uninsured depositors of those two failed banks, and between them, that's a lot of deposits. Between them, actually, that is more deposits in failed banks than we've had. 2023 is now a record year, going back to the formation of the FDIC in 1933, 1934. 2023 is a record year for deposits having failed, for deposits. This is a bigger number than 2008, 2009 already in March 2023. So step one was ensuring all of the deposits, including, and this kind of puts the whole FDIC model, the threshold into question, because now, sensibly, there might be a view that all deposits, uninsured or otherwise, are going to be insured de facto. There are implications for that. Who bears the cost of that? Ultimately, it will be the industry, therefore the depositor. So all depositors, even those under 250, are ultimately going to pay for insurance that only the wealthiest and businesses will now be benefiting from, having not benefited from it historically. Anyway, that's one point. Second point is the one you raise. Very interesting and really unprecedented, I think. I don't know, I'm sure Dominique will have a view on this. Unprecedented central bank accepting collateral at higher than market value. And in some cases, Silicon Valley obviously isn't going to be able to benefit from this, but its held to maturity book was being carried at 83 cents on the dollar. So the facility to be able to put that as collateral into this new program at 100 cents on the dollar, very attractive. What it does actually is it cements this notion that it is a held to maturity. Previously, banks had worked under the deceit that they could hold these bonds to maturity. That kind of only works if they're around at the time of maturity. Silicon Valley and Signature are not going to be around. But what this does is it actually crystallizes that deceit, if you like, because the authorities will now say, these are money good to maturity, and you can put them to us in order to get funding. The only wrinkle is that, there are two wrinkles actually. One is that it's not cheap. It's 5% funding. So these banks are going to be underwater if they're receiving 5% funding on bonds which they bought in 2000, which are yielding 1.5%. But that's an earnings issue. It's not a solvency issue. So net interest margins will decline. Second issue is a lot of banks, it's recovered today, but there was a lot of question marks around FRC, First Republic of California. Yesterday, their issue is they don't have securities. It was a lending bank, as most banks are, and there's no capacity to put loans into this window. So those are the issues, but yeah, like I say, pretty unprecedented.
And were you surprised that markets continued to sell off yesterday after the announcement of the rescue? Because surely it sounded like the government and its various instruments had underwritten the system.
Yeah, I was. It looked like I mean, the Hank Paulson phrase, the bazooka. It looked like a bazooka, kind of breaching FDIC protocol around the threshold, and then kind of central bank protocol around the valuation of assets. But then, having said that, coming back to how I started, you'd never seen a bank collapse. Silicon Valley Bank was trading in a premium to book value on Tuesday of last week. The CEO was at a tech conference last week talking about all sorts of stuff, none of the risks being highlighted. It wasn't the case with Washington Mutual. Many of the banks that failed in 2008, 2009. Actually, peak bank failures, we think about the crisis as being 2008. Peak bank failures wasn't until 2009, and actually even in 2010. Very slow burn. The idea that, so I think it just freaked investors out that you can be holding some paper one day, be it bond paper or equity paper, and then in 2 days' time, it's just gone. And that's an issue of confidence. And that's going to create some scar tissue.
And I mean, do you think we are at the beginning of a potential bank crisis, or do you think this is, we are? I mean, this is going to be...
I don't. I think this was very, as I say, confluence of two factors. The intersection of those two factors made certainly Silicon Valley Bank a very special case. The third factor arguably is crypto, which took down Silvergate and Signature. So very special factors. I don't think we are at a crisis point. I think there will be earnings pressures on banks now, which there's an impact actually on their propensity to lend, given that they might have to hold more, they'll feel that they need to hold more cash going forward. Ultimately, I think the market drives the regulator. We saw that in 2008. And so there'll be a demand amongst investors for banks to hold more cash, higher capital ratios, less uninsured deposits, all of which will have an impact on the economy, on the system. But none of it suggests a crisis.
Okay, great. Okay, so let's turn over to Dominique. I mean, we will open this up to questions from the participants. Dominique, what's your take on all of this?
So let me talk about impact on the US economy and the Fed. In terms of very short-term impact, so next week Fed meeting, it's very clear that the Fed is not going to hike if the market is in turmoil, if regional banks are losing deposits, and if we have major instability. But if you look at what's happened today, actually we've seen markets normalizing, indicators of funding stress getting better, huge recovery in the stock price of regional banks. I think if we continue on that trend, there is a good chance, given that the Fed inflation problem is getting worse, not better, there is a good chance they could hike 25 basis points. But this is a very short-term view and not that important in the grand scheme of things, because whatever the Fed is doing next week, it can always offset by hiking more further on. So in terms of the Fed, the question is, how does this event impact the long-term prospect for the US economy and for inflation? And I agree with Marc, this is not a solvency crisis. This is more a liquidity crisis, liquidity/confidence crisis, where the main bank that went bankrupt did so for very specific reasons. That said, there are some issues, medium-term issues there that could impact the medium-term outlook. And a key issue is whether we are going towards credit crunch, where credit availability is curtailed. And the main channel through which this could happen would be through regional banks losing deposits. And we are seeing that deposits are moving from regional banks to the big four, and eventually regional banks getting merged. And there have been a lot of academic studies on the impact of bank mergers on credit availability. And it tends to be bad, especially for small borrowers who have no alternative but to depend on banks for getting credit. So this is not my base case scenario. I think that once we get over this loss of confidence, the economy will be back on its trajectory. So I am sticking to my close to 8% long-term Fed call. But it is a risk, this credit crunch, and the government is going to have to take some steps to prevent that credit crunch from happening. And to me, one of the key steps is going to have to make the guarantee of all deposits, no matter the amount, explicit, because otherwise, smaller regional banks are going to be at a disadvantage. Either they will lose deposit to the bigger banks, or they will have to pay such high deposit rates that they won't be viable. And basically, this is a little bit what Marc was mentioning when he was talking about the speed at which a bank run happens in the digital age. And I think a direct consequence of that is that partial insurance of deposits is no longer viable. And so banks are going to be more regulated. I think we're going to have a move of credit supply to the economy, to the non-bank sector, with bank becoming more like utilities. But this is a long-term view. In terms of the Fed, based on this crisis of the Fed and the economy, based on this crisis being more liquidity and confidence and solvency, my long-term outlook has not changed.
And Dominique, just to challenge you there a bit, many people have said the Fed will continue to hike until something breaks. Now something has broken, US banks or regional banks. So surely, at the very least, this changes the risk return for the Fed. So why continue to hike so much? Why not just maybe do one hike and then stay on hold and just see what other bodies turn up in the water?
So for sure, the Fed is going to tread very gingerly, which is why I'm thinking that 25 basis points next week, based on market stabilization, is more likely than 50. Given the CPI we had this morning, I would have said 50. So there is a possibility that the Fed is a little more cautious. But the Fed has a problem. Its mandate is inflation. It's put in place a super duper risk management framework after the GFC. Banks have been regulated to death. Maybe Marc has a different view on this, but certainly the regulatory framework has tightened. The Fed cannot stop hiking when inflation is 7% and accelerating. This is what inflation data basically shows, like median price inflation and so on and so forth. We're not having disinflation, so they cannot stop because they are afraid that the risk management system they put in place and they are accountable for is not working. They just have to keep going. Though I will grant you this accident highlights the situation of the Fed caught between stabilizing inflation and stabilizing the financial sector. And going forward, it's going to get worse, not better. But we are not there yet.
Great. No, thanks for that, Dominique. Everyone sort of keep your questions coming in. I'll sort of collate them and ask them after we finish the speaker segment. So thanks, Dominique. Let me go over to Mustafa now. So Mustafa, I mean, you've managed big ALM books and such, and you're a rates person. I mean, what's your take on what's been happening?
Two things I am looking at. Both Dominic and Marc has talked about the package that came from the government was quite good and stops a bank run from happening. But going forward, there are two things I'm worried about, and one is that the Fed at this point starts to doesn't in terms of hiking, it may stop hiking. It's in a dilemma right now in terms of how much more hiking to do. So it may be comfortable with a higher interest rate inflation target going forward. So that's one that Fed could be pursuing a higher inflation target. The other thing that worries me is that the banking systems balance sheets are now open. It's open in the sense that there are way more risks sitting there in various places that wasn't that clear. For example, the health. If you look at the amount of balance sheet that moved from the beginning of the Fed tightening cycle to now, from AFS account to HTM account, it just tells me that banks, instead of hedging ahead of the Fed tightening cycle, they decided to avoid hedging and put highly negatively convex securities in their balance sheet in a held to maturity account. So now we have a significant portion of the balance sheets that are unhedged. If you look some of the back of the envelope calculations that I've done, the duration extension of bank mortgage portfolios, both securities and whole loans, could be as high as 2 trillion 10-year equivalents. So risks are accumulating in bank balance sheets. Government is guaranteeing the depositors. So what becomes more vulnerable are bank equities and bank unsecured debt. And that we already seen that happen. And that that could have a systemic effect in causing asset prices decline. So higher inflation target, significant outside of the liquidity problem is solved, but asset prices, the contagion from bank stock prices to rest of the asset market, all of that causes it causes some risk premium to be higher than what we have seen so far. So I still think that real rates, having long the real rates in the belly of the curve, is the right place to be, because if we may have break evens creeping higher as Fed targets a higher inflation rate. So belly of the curve does well, but there's still risk of the 8% scenario, where 8% Fed fund scenario. So short the 2-year sector is still a good idea. And in terms of vol has gone up to almost crisis level. So it's not a buy at this level, but as it goes down, I would pick up vol.
Okay, no, great. Thanks for that, Mustafa. I also wanted to share some of my work on this topic as well. I'm going to just share my screen now. I wrote this note earlier today where I talked about 3 things everyone's missing about the bank failures. This actually went to our institutional clients. So if you access our institutional product, you'll get hold of this. But the first thing was obviously the banks have this unrealized loss on their balance sheet, but who has the unrealized gain on the other side? Because obviously a loss must be matched by a gain. And in my view, the gain is on households. So what's happened is households have actually gained have an unrealized gain, whether they realize it or not. And one way of looking at that is if you look at this orange line here, shows you the share of people's disposable income that is in mortgage payments. And so what you see is it's picked up a bit, but we're pretty much where we were before COVID. We haven't gone up to even levels we saw in 2008 or 2007. So people's mortgages in the US, the rate they're paying is actually quite low because people locked in very attractive mortgage rates. And so in some ways, households are short duration, and so they're benefiting from the rising yield, whereas banks are long duration and they're losing out. So this is one of the reasons why I think Fed policy hasn't had as much of an impact on inflation, because households aren't feeling the pain as much. So as long as these bonds are still held by either banks or they're held by the Fed and they're not sold into the market, then this dynamic could well continue. It could keep yields lower than they otherwise would be. The second point is just in terms of bank failures. This is a rolling 12-month sum of bank failures. According to the FDIC, we see in the 1980s, there was loads of bank failures. At one point, over the space of 12 months, there were 700 bank failures during the S&L crisis. During the GFC, there were less numbers, but it peaked around 200. Obviously, there were larger banks then. If you adjust for asset size, about 30% of the financial system during the GFC went into a failure of some kind, whereas in the S&L crisis, around 5%. Today, so far, it's about 1%. So the magnitude is still quite small, although the pace has been very rapid. Interestingly, in the 80s, the Fed did continue to hike rates when banks were failing. So I think that's a salutary point, that when you have inflation as a backdrop, it doesn't necessarily mean that the Fed will stop hiking. And then the final point I'd make is that if you look at the performance of stocks, so this is the performance of different financial subsectors relative to S&P, you see that banks in general have been either following the S&P or underperforming the S&P since 2008. The one area that's really been outperforming the S&P is private equity. Now, private equity has really had an amazing performance over the last 5-10 years. And my view is, I think that's the area of the financial sector that's probably most vulnerable, because in a higher rate environment, tech weakness and so on, I think PE is the area that will come under fire more than even banks from here, because I think they've had a much bigger run up. So anyway, quick digression there to show off some of the work that we've done at Macro Hive. Now what we'll do is we'll take some questions from the audience. So feel free to sort of send questions over. So the first question I wanted to ask was, this is from Dimitri, who's asking, maybe Mark, maybe you could tackle this one first. This is in relation to deposit flight, and I've heard this from lots of people. We're seeing, higher rates are available to depositors in money market funds and directly in T-bills. Isn't that going to just lead to deposit flight into money market funds, and then consolidation in the bank sector to just 5 big US banks or something? I mean, when it kind of, you get this sort of barbell effect, is that what could end up happening here?
Yeah, so we were seeing deposit flight anyway. And actually, one of the risk management issues banks are currently facing is they've never experienced that before. Rarely have deposits shrunk in the industry to the extent that they did already in 2022. We had 4 quarters of declining deposits in 2022, compared with 10 individual quarters of declining deposits going back over the past 50 years. Clearly, the reason is because the deposit inflows were unprecedented in 2020 and 2021, but they were unwinding already. One factor bank investors look at is the so-called deposit beta, which is the amount of policy rate hikes that are being passed on to depositors. And that had been quite low. There's a kind of a lag, there's an inertia where depositors don't wake up to the fact that Fed rates are significantly higher, particularly given how rapidly they were hiked. And so banks have only passed on about 20-30% of those hikes. That will now change. That will go higher. They'll have to compensate depositors increasingly. And we are also seeing, Dominique mentioned this, and we saw it over the weekend, a lot of deposits flood back to the too big to fail banks, the 4 too big to fail banks, which creates various balance sheet management issues for them. Jamie Dimon at JP Morgan had already said he'd already bemoaned the fact that he was inundated with deposits through that period, but they are coming back. The point about consolidation is interesting, and it could be that one of the reasons why no bank bid for Silicon Valley Bank in the auction that was conducted on Sunday, or even privately on Friday, is because maybe they're going to get the deposits anyway. JP Morgan, be interesting to see where those deposits end up. I suspect a disproportionate amount will end up with the too big to fail banks anyway.
And then there was another question, this is for you, Marc, again, from Nihal, who basically says that obviously the hold to maturity MBS securities are being viewed, with a critical eye. But what about the bank's loan books and their, other mortgages, like the non-agency mortgages? They lose value, because rates rise. Is there some, it's opaque? I mean, is that going to come under scrutiny then?
Yeah, it's a really good point. I think there's a parallel here, which is in equity markets, where there's a disconnect between, this was a feature in 2022, between public markets and private markets, that private equity portfolio valuations were higher than public market comparables. It's true within venture capital as well. Similarly, public market tech valuations took a bigger hit than, in most cases, private market peers. So it's a really good point. That is right. I think the difference, it's not fundamentally a difference between securities and loans, but it's certainly a difference between this period and 2008, is that we're not seeing any credit problems yet. And whether it's on mortgage-backed securities, even non-guaranteed kind of jumbos, or whether it's on loans, we're not seeing any credit issues yet. Right now, this is an interest rate issue, which still feeds through into Marc's. We're not seeing any credit issues yet, but it's a really interesting point, the difference between loans and securities, because it's a feature of the US specifically that mortgage lending kind of gets washed through the securities market. In Europe, that's not the case. Banks will retain mortgage loans as loans on their balance sheet. In the US, they'll kind of get washed through securitization. In many cases, end back up on banks' balance sheets, be treated differently, but fundamentally, the asset and the risk is the same.
Yeah. And there's a couple of questions which are kind of in the same direction, which is, what does it mean for the UK and Euro area banks?
Yeah, again, really interesting point. Historically, we have seen contagion from US into Europe, less so the other way around. It's come through the dollar. So there's a kind of a macro reason for how that contagion spreads. This time around, actually, the European regulators look pretty good for two reasons. One is there was never a differentiation in Europe between big banks and small banks. We saw that differentiation in the US between the 4 big banks, or there's a few more than that if we throw Goldman in, but the G-SIFI, the too big to fail banks, and then banks that aren't G-SIFI but are over $700 billion. And there are various thresholds, 4 categories actually of bank in the US. Silicon Valley Bank CEO himself had lobbied extensively for relaxation of standards. But in Europe, we don't have that. So in Europe, banks are all treated with the same regulatory brush. That's one point. That's one point. Second point is that on liquidity risk, so US stress tests, which are conducted for the larger banks every year, very geared into a recessionary scenario. And in a recessionary scenario, the interest rate component is for low rates, for low rates. And there was less testing, less public testing. So supposedly banks did discuss their interest rate risk with regulators on an ongoing basis. I hope when we have an inquiry on what happened at Silicon Valley Bank, we'll get some disclosure of what went on in those discussions. But in Europe, it's all public. LCR, liquidity coverage ratios, all public, and then actually a final point as well. You can see in the as a result of that, they had to hold more high quality assets in Europe and more cash, and as a result of that, the losses on held to maturity are a lot lower amongst European banks than they are in US banks.
Okay, that's
and then one final point, actually, coming back to my point about the confluence of two factors: less uninsured deposits in the banks, which is interesting because actually money markets and short-term treasuries are less easy to access in Europe than they are in the US, and yet in spite of that, there were still more uninsured deposits in the US than in Europe. So across all of those factors, less risk in Europe, and the contagion really historically has come through the dollar, and we're not seeing that this time around.
And just in terms of one European bank that is constantly being talked about, is Credit Suisse. Now, is that just a case of it's not really related per se to Silicon Valley? It has its own idiosyncratic issues and it's just struggling on its own, or is Credit Suisse a canary in the coal mine for Europe?
No, yeah, it's a really good point. I would say it's a really good point of how things can work given good regulation. Credit Suisse lost 37% of its deposits in the fourth quarter of last year. So it's a pretty massive deposit outflow. Yeah. Similar factors around run in the digital age. It was triggered by some social media commentary at the beginning of October. The LCR ratio went down to, I think, 100. It went from 160% or so to 140%. So there was a drawdown in the ratio, but it kind of worked. The liquidity was there to meet those deposit outflows. I think they just said today, the CEO was being interviewed today, and he said that they actually filed their annual report today. And in the annual report, it says that although the outflows have slowed, they haven't yet reversed. But the CEO said that they received inflows yesterday on Monday. And he said the LCR has gone up actually from 140% average in the Q4 to about 150%. Those are the numbers I read. So it kind of shows how things can work in the event of a run. But yeah, very, very clearly, you're right. Very clearly, it is the bank, even having raised capital recently, it is the bank that investors and the market generally looks at.
But I guess to some extent, if you look at the price to book and everything, I mean, it's kind of a known, it's just slowly bleeding over time, I suppose, rather than a big surprise. There are a few more questions. I mean, I guess this is probably more for Dominique. Here's one from Dimitri. Is there a deliberate strategy by the Fed to continue tightening credit conditions through rate hikes and balance sheet contraction while using measures like the new term funding program to maintain financial stability? So I guess the question is around, is the Fed going to kind of, separate financial stability policies from monetary policy? Dominique, do you have a view on that?
Sure, that has been the Fed dogma forever, that rates and QE, QT should be used for macroeconomic management, and that financial stability should be handled through prudential rules or through other instruments. So I think the Fed is going to be very keen to show that there is no financial dominance, that they are still free agents and able to deliver on its inflation mandate. And so I expect them to continue on this dual track.
Okay. And then here's another question. I mean, somebody's asking, this is, I think, Andrew, who's asking if there's not, if we accept that's not a solvency crisis, at the same time, markets have moved a lot, have reacted to this all. I mean, is there something in the markets that telling us that the slowdown or the recession is happening sooner than we think?
So I'm not seeing it in my data, but I mean, who knows? I don't think, we are making a big fuss of this thing, and we are right to do so. But most Americans are probably not paying much attention otherwise than hearing the name of the bank through the news. So I'm not sure we have a panic like in 2008, where behaviors would be impacted. Also, as you explained, Bilal, US consumers have super strong balance sheets. They are the winners so far. So based on the data, I'm not seeing a bigger risk of a recession.
Okay, great. Now, the final batch of questions, I'll just address this to Mustafa. So Mustafa, one question is, how much of the recent moves we've seen, especially in rates, do you think has been just a position adjustment, like a big squeeze in markets, rather than a fundamentally driven move? Because obviously we've seen a massive rally in rates. What's your take on like position adjustment versus some fundamentally driven change?
I think there is a significant amount of position adjustment. It was pretty clear the second order reaction. The first, we got the massive steepening of 2/10, about 180 basis point. Then we flattened back to about minus 70, and the first reaction was a global rally across the curve, global steepening, Eurozone in the US as well as in Japan. And then after the Fed announced this rescue package, some of the markets came back, but the Japan didn't. And that just shows that a lot of it is position squaring. You get the Japanese JGB markets kept rallying, while the US and the Europe bounced back somewhat. To me, it says that there must have been a lot of flow squaring cross currency rates trades, and then anxiety is differential in different parts of the world in terms of what might happen going forward.
Okay, yeah.
And the spike in vol also says that we're in a crisis level fall at this point in short dated rates fall.
And then there's the final question is this from Bruce. Won't the slow bleed of negative carry that the banks have lead to a solvency problem that ultimately the taxpayers will have to bail out the banks? Mustafa, what do you think?
I think it's a bigger problem than assumed. We just save only the depositors, and most probably also hopefully the uninsured depositors as well, which essentially means we moved some of the duration risk that the depositors have indirectly to the government's balance sheet. But the extension of duration in bank balance sheets has been monumental. And what you addressed, Bilal, is the gains of rate increase have gone to homeowners, but there's a duration aspect of it, and the very long duration in the bank's balance sheets that's under cover of HTM, etc., and also the loan portfolio. Eventually, the market will and at the same time, equities are not bailed out, neither are unsecured debt. So market will punish equities, market will punish unsecured debt to compensate for the fact that the deposit risk has been guaranteed. So it's like a string. You protect once and you open up the other side of the balance sheet even more. So, and that's maybe a slow bleed. But if we go to the 8% Fed funds rate that Dominique is talking about, the MBS would also widen big time in that scenario. And at this point, primary mortgage rate is about 7%. If we go to 8, 9, 10% at the 8% Fed fund scenario, we are going to see even the slow bleed become very fast, even if deposits are guaranteed.
Okay, no, thanks. So, and Marc, just I'll ask you the same question as well. The negative carry, the net interest rate margin, declines, I mean, can it go negative, or the declines? I mean, will this ultimately lead to a solvency problem?
Yeah, they won't go negative overall on the back book, but certainly incremental margins. I've talked before about borrowing through the new facility at 5% in order to fund securities which are yielding 1.5%, and then at the same time, deposit costs are going to go up. But even if deposit costs, clearly, this is a bigger risk for those banks with big securities portfolios than it is for banks with loan portfolios, where the loans reprice much more quickly and are typically high yield anyway. But for sure, for some banks, we'll see pressure. It won't go negative overall, but I'll certainly see pressure on incremental margins. And so it's an earnings risk, but not a solvency risk.
Yeah. Okay, great. Okay, well, thanks a lot to the panelists, Marc, Mustafa, Dominique. Excellent contributions. Hope everybody's found something useful in this webinar. There'll be a link to the recording of this, so feel free to share that with other people as well. And once again, just hope you enjoyed this, and good luck trading these markets. Thanks a lot, everybody.